For decades, the U.S. guaranteed Gulf security while Saudi Arabia stabilized oil markets, pricing crude in U.S. dollars, a system that cemented American dominance. But recently, Saudi Arabia began exploring new alliances and currencies, shaking the foundations of this arrangement. Its flirtation with the BRICS bloc and consideration of trading oil in Yuan signaled a desire for strategic autonomy and a multipolar world. Yet, in early 2025, Saudi Arabia reversed course, signing a $600 billion partnership with the U.S., reaffirming their alliance and leaving the world scrambling to interpret the new rules. This saga is a preview of a world where alliances are fluid, loyalty is transactional, and global power is up for grabs. To truly understand Saudi Arabia's recent pivot towards the East, we need to examine the growing influence of BRICS, a coalition that's rapidly reshaping the global economic landscape. Brazil, Russia, India, China, and South Africa originally came together to challenge the dominance of Western-led institutions like the IMF and World Bank, seeking to create a more balanced global order. For member states, BRICS offers not just economic diversification, but also access to enormous and fast-growing markets. This is especially significant for energy exporters, as China alone is the world's largest oil importer, driving demand and opportunity. Membership in BRICS means a degree of insulation from economic downturns in the West, and a seat at a table where the balance of power is shifting away from Washington and toward emerging economies. In 2023, the bloc made a bold move by expanding its membership, inviting Saudi Arabia and other key players. This expansion was designed to amplify BRICS's economic clout and strengthen its influence over global energy markets. For Saudi Arabia, joining BRICS was more than just a commercial decision. It was a strategic step, signaling a desire for greater independence from traditional Western alliances and a willingness to chart its own course. The move also acknowledged Saudi Arabia's growing leadership role in the global South and offered a platform to help shape a more inclusive and multipolar world order, one where emerging voices are heard. Yet, the appeal of BRICS for Saudi Arabia has always been tempered by the complex realities of global security, shifting alliances, and the need to maintain leverage in a rapidly changing world. The most radical aspect of Saudi's BRICS flirtation was the idea of pricing oil in Chinese yuan, a direct challenge to the petrodollar system. Since the 1970s, oil has been traded in US dollars, creating global demand for the currency and giving America immense financial leverage. Any move by Saudi Arabia to bypass this system would have profound implications for US power. For China, trading oil in yuan would boost its currency's global standing. For the US, it threatened the dollar's dominance. While a full collapse of the petrodollar wasn't imminent, the mere discussion signaled that old certainties were fading. The world was watching for the first real crack in a 50-year-old foundation. Just as the world braced for a dramatic Saudi pivot toward the east, with speculations swirling about a new era of alliances and shifting global power, an unexpected move sent shockwaves through international circles. Riyadh stunned everyone by signing a colossal $600 billion strategic partnership with the United States during President Trump's high-profile 2025 visit, a deal that few saw coming, and one that instantly changed the calculus for global diplomacy. This sweeping agreement spanned energy, defense, technology, and infrastructure, promising to inject vast resources into Saudi development while deepening military and economic ties between the two nations. It reaffirmed America's role as Saudi Arabia's primary security guarantor, ensuring a continued U.S. military presence and advanced defense cooperation in a region fraught with uncertainty. This bold move came after months of intense U.S. diplomatic pressure, with American officials making it clear that the stakes were higher than ever. The U.S. even threatened steep tariffs on BRICS countries, warning of economic consequences for those pushing de-dollarization and challenging the dollar's dominance in global trade. Saudi Arabia found itself at a crossroads, caught between the economic promise and rapid growth of the East, and the unmatched security muscle and influence of the West. The partnership was a classic case of carrot and stick, offering massive investment, lucrative contracts, and security guarantees, but also making clear the risks of drifting away from Washington's orbit. For Riyadh, the deal meant not just financial windfalls and new infrastructure, but also a renewed sense of protection in a volatile region. Yet the message was unmistakable. Should Saudi Arabia stray too far, the threat of diplomatic and economic isolation loomed large. Ultimately, Saudi Arabia chose a path of stability and leverage, securing its interests while keeping powerful allies close. The move demonstrated that, despite rising competition, American power and influence remained decisive in shaping the region's future. The $600 billion deal reset the global chessboard, forcing nations to reconsider their strategies and alliances in a rapidly changing world. It was a powerful reminder that the United States still possesses the tools and the will to shape outcomes on the world stage. While strategic autonomy remains an aspiration for Riyadh, the realities of global power politics demand careful, pragmatic choices. For now, pragmatism prevails, as Saudi Arabia navigates a complex world with both ambition and caution. The US-Saudi deal sent shockwaves through global markets, instantly reinforcing the petrodollar system. The threat of Saudi oil and Yuan vanished, calming fears of rapid de-dollarization and securing the dollar's reserve status. For BRICS, losing Saudi Arabia was a setback, exposing the bloc's limits in matching US security guarantees. The renewed alliance brought short-term stability to energy markets and concentrated power in Washington and Riyadh's hands. Yet, the episode showcased Saudi Arabia's diplomatic agility, leveraging its BRICS flirtation to extract a massive deal from the West. Other middle powers are taking note. Playing great powers against each other can yield big dividends. The landscape is now more fluid and competitive than ever. While Saudi Arabia made headlines, Qatar quietly pursued its own pragmatic strategy. As a top LNG exporter, Qatar deepened ties with China, signing long-term gas deals increasingly settled in Yuan. Unlike Saudi's high-profile moves, Qatar's shift was gradual and commercially driven, reflecting the slow internationalization of the Yuan. Qatar maintains strong U.S. security ties while expanding economic links with China, embodying a strategy of balanced partnerships. Across the Gulf, states like the UAE are also hedging, joining BRICS but keeping deep Western ties. The lesson over-reliance on any single partner is a vulnerability. The future is about diversified alliances and maximum flexibility in a shifting world. The focus on the US-China-Saudi triangle misses another trend. New, flexible alliances are emerging. A pragmatic axis between Russia, India, and Saudi Arabia is taking shape, driven by shared interests in energy and trade. India's growing energy needs, Russia's search for markets, and Saudi's production power create a formidable bloc. Joint projects like the International North-South Transport Corridor aim to bypass Western-controlled routes, integrating Eurasian economies. These partnerships are about mutual benefit, not ideology, reflecting the complexity of modern geopolitics. India, for example, balances ties with both the US and Russia, pursuing a multi-aligned foreign policy. Friction with the US over Russian trade hasn't stopped India from deepening these relationships. The new reality national interest trumps bloc loyalty. Over the past year, the world has witnessed a dramatic shift in global alliances. Saudi Arabia's growing engagement with BRICS, its willingness to challenge the petrodollar, and its bold diplomatic moves have all signaled a new era in international relations. The massive new deal with the US, juxtaposed with Saudi's overtures to the east, marks the end of a world dominated by a single superpower. Instead, we are entering a period where influence is shared, and alliances are constantly in flux. The United States, while still a formidable force, now faces the reality of having to compete for global influence. It must use a mix of incentives, partnerships, and sometimes even pressure to maintain its standing. Meanwhile, Gulf states are deepening their economic and political ties with Asia, recognizing that the center of global economic gravity is shifting eastward. This pivot is not just about trade, but about securing their future in a rapidly changing world. The petrodollar system, which has long underpinned American economic dominance, remains intact for now. However, the trend toward de-dollarization in other sectors is unmistakable, gradually chipping away at the unique privileges the US has enjoyed for decades. The Chinese yuan is slowly gaining ground as an alternative, but its rise will be measured and incremental, reflecting the emergence of a more multipolar and competitive global financial system. The most important takeaway is that hedging has become essential. No nation can afford to put all its eggs in one basket or rely solely on a single partner for its security or prosperity. Saudi Arabia's strategic maneuvering is a masterclass in leveraging great power competition to maximize its own interests, extracting value from every side while keeping its options open. In this new era, international relationships are increasingly transactional, alliances are fluid, and every nation must constantly reassess its interests. The world is more complex than ever, and adaptability is now the key to survival and success.